From a dividend standpoint, the only other time where they paid over 6% was during the 2008 financial crisis. This would be the buying opportunity of a lifetime. I mean, literally of the last 20 years. Today, folks, we got to talk about the monthly dividend company that is crashing. And no, I did not quote this company as the monthly dividend company. That's what they call themselves. And of course, we're talking about Realty Income, beloved amongst many of the dividend investing community, a self-proclaimed dividend aristocrat. Like, they quote themselves so much as being one of the best dividend stocks out there, and we're going to kind of find out if they are, because they've recently been falling off a freaking cliff, and recently they dropped even more as they announced a massive acquisition we're going to break down. But this stock is now down 20% over a 5-year basis. If we take the peak to trough here from when they topped out just before the pandemic, now hitting their pandemic lows yet again, down 42% with a whopping 6.65% dividend yield. Oh my god, guys, we got to get right into this. If this is a conversation you'd appreciate, hit that like button, because Realty has always tickled my fancy. It's probably one of the best performing REITs over their entire history. They actually have offered an outsized return that has outpaced the S&P 500 around 14%, which is very insane for a compounded annual rate of return. I don't know if that's still calculated with the recent drop in the stock, but something tells me this is going to be a short-lived buying opportunity, because I think there will be recovery in this from the current price that it's offering. But taking a look at the top tenants, they work on a triple net lease structure, which I obviously stated that if I could ever buy real estate, it would be triple net lease, because you don't actually manage the property. You don't have to worry about the building. That is all relied on the tenant, but you own the property and you just collect cash flow, so there's no management involved from your end. But we can see Dollar General, and knowing how recession proof these dollar stores have been, because Dollarama here in Canada is like one of the best performing stocks. It's proving to be a great tenant, and it's their largest tenant at 3.8%. Walgreens at 3.8%, Dollar Tree at 3.3%, 7-Elevens. You've got Wynn Resorts, which was a recent acquisition of theirs. FedEx, for crying out loud. You got Lowe's in here. You've got a little bit of theaters, which I'm not the biggest fan of, but man, what a diversified tenant list, with convenience stores and grocery stores making up the whopping over 20%, dollar stores making up 7.1%, home improvement 5.9%, drugstores at 5.8%. I mean, could you ask for a more diversified portfolio list, even with global diversification, with 10.5% actually being in Europe? So, I mean, nothing wrong with the tenant basis, and they've been doing a pretty good job at continuing to acquire. They've been doing this through dilutive measures, so I don't mind if I'm losing my my share of the pie if they're investing that capital correctly. And you kind of got to ask yourself that question: do you believe them purchasing Wynn Resorts for $1.7 billion was worth it? I like gambling. As my mother always says, it doesn't matter how broke you are, people always seem to have money to buy lottery tickets and cigarettes, and that's proving to be true even in this recessionary environment. They're also kind of doing strategic partnerships with companies that are getting into vertical farming, which is also very intriguing, because vertical farms, they're just taking shipping containers, adding literal farms inside of them with like UV lights, and they can put them anywhere where they're not like, farmland specific or weather, they can't be hindered by the weather either. And they're also expanding into Ireland as well. So lots going on with this company as it stands today. And most of their triple net lease agreements last for about 9.6 years. So you do get a long runway ahead of you, with 49% of these leases coming due in 2032. So, I mean, these tenants should be around for quite some time. Now, taking a look at the recent acquisition of Spirit Realty Capital for $9.3 billion, this is what's tanking the stock today, even though I don't think the deal is going through yet. And that's because basically Spirit shareholders will receive 0.762 cents or 76 cents of newly issued Realty Income common shares for each Spirit common share that they own. So this is going to be a dilutive measure, and it's a pretty big one at that. I mean, we're talking about $9.3 billion worth, and considering Realty right now is trading at around 32 billion. I mean, this is a massive share purchase. I'm not necessarily against this, because if we actually take a deeper look into Spirit just to see what the company is, we can see they've got about, again, that $9.3 billion of investment value, 2,000 properties, 345 tenants, great occupancy ratings, and we can see that a lot of this, 39% or damn near 40%, is in service and retail, which is very reminiscent of Realty Income, with health and fitness, convenience store, car washes, casual dining, entertainment. My more intrigued aspect of the their tenant basis is in industrial, because the industrial sector has been one of the best performing REIT sectors, making up 25%. So this is obviously distribution, manufacturing, industrial, outdoor storage. Very intriguing aspect. You got discretionary retail, non-discretionary retail, other things making up a smaller percentage of their entire tenant mix. But if you scroll down, again, very diversified across the U.S., a very similar REIT to O Realty. So it kind of has a lot of synergies that make sense for this acquisition to go through. So I'm very intrigued to see what happens from that aspect of it. But let's break down the numbers and see exactly what's going on and if the stock is truly a buy. So from a dividend standpoint, the only other time where they paid over 6% was during the 2008 financial crisis. So if you believe they're not going to cut the dividend, and as much as they pride themselves on the dividend, I believe there's some stability here. This would be the buying opportunity of a lifetime. I mean, literally of the last 20 years, with the exception of 2008. Revenue growth is absolutely astounding, and this is only going to continue to go up with the recent acquisitions. So going to be seeing continued revenue growth. Does it hit the bottom line? Well, they've been doing a pretty good job at maintaining the EPS through this rougher market environment, though it is downtrending. You can't really trust EPS on REITs because there are depreciation and amortization costs that don't directly get attributed to the free cash flow. So you can't really trust the payout ratio on Yahoo Finance either. But speaking of that, let's just take a look at their assets. As the company's currently trading for around 53.9 billion based off their June filings, and we are getting earnings coming out, I believe, November 6th, something to look forward to. But 53.9 billion dollars in total assets against total liability of 22 is a very, very healthy debt to asset ratio. I mean, that gives them what minus their liabilities is sitting well over 33 billion, and that's pretty much the value of their actual market cap today. So you're getting it for the NAV value. Basically going a little bit deeper into this, taking a look at the revenue growth, again, absolutely astounding. 6 months going from 1.6 to 1.9 billion on rental income. I don't think you could complain too much about that. You can see the depreciation is almost $1 billion over that 6-month period. So that's writing it down. That doesn't directly reflect on the cash flow. Lots of room probably to pay that dividend. But what I want you to pay attention to is the provisions for impairment. This is intriguing to me because it's gone up pretty dramatically on a year-over-year basis, which might show some signs that they are a little concerned about some of their tenant bases, as they are putting provisions for impairments, which just basically means they'll have some delinquencies on some of these tenants. That is something to be kind of concerned about. It's nothing too crazy, though. It's not something we'll have to listen to on the earnings call. We can see their interest expenses are going up pretty dramatically here, from 216 to 337 million on a year-over-year basis. That's almost a 50% increase, so that's pretty dramatic. This isn't like the most, it's a very healthy balance sheet, mind you. Now, you're going to want to do some more digging because there are obviously some macroeconomic effects that could continue to hinder the company, but they have really resiliently rode through many of the hardships that they've been faced since they're coming public years ago. So I wouldn't be surprised if they ride through this no problem. They do have little debt incomparable to a lot of REITs out there, probably very manageable. Obviously the rates can be negotiable down the road. And again, from the dividend standpoint, I mean, we're talking about a company that isn't growing its dividend as quickly as other stocks. I think their GIGAR is around 3%, 3 or 4%. So they have been keeping up with inflation, just above inflation over the historical standards. So it's nice you're getting a dividend that historically has kept up with inflation. And on top of that, if you buy it today and they continue to achieve those kind of goals, I mean, you're really not complaining at a starting 6.6% yield. This is one that I've been thinking about picking up, but I'll keep my eye on it for now, and I'm looking forward to the earnings. But I'll pass the question off to you. What do you think about O Realty Income? Are you buying it?